Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring Live. And recently I've had a few emails from some of the viewers of the live cast, and they said, Greg, would you be able to make a quick video going through each of the indicators on your chart and kind of giving us an idea of what they are, what the settings are, and I think it's a good idea. So what I'm going to do is I'm going to start with just the price. We're going to get as basic as possible. And so for some of you, this is going to be pretty basic, and you probably already know most of these. But if you're just getting started, I think this is a good opportunity for me to just go through the basics. And so what I'm going to do is I have a bunch of indicators on the chart. I'm going to start with just a blank chart, and then we're going to go through and we're just going to add the next one and the next one and the next one. And by the end, it's going to be a little busy, but that is just how I have my chart set up. So I like to be able to look at my chart and have everything there so I can make the best decisions. Make sense? So okay, so first of all, I'm going to start with the list, just so that you have a basic list so that you can see everything. And then, like I said, we're going to add one indicator, and then the next, and I'll talk about each indicator as we go. Sound good? So, okay, I am going to turn off the webcam because I'm going to be looking away, but I will come back and say goodbye when we are finished. So, all right, let's change this around here. We'll put Katie and I back up. And okay, let's take a look at the list. So, okay, the first thing we have to have on there, obviously, are price bars. Like I said, we're going to go through this one by one, but we have price bars. We have the 250 simple moving average. That's what SMA stands for, simple moving average. We're also going to put over the 200 SMA, simple moving average, the 100 simple moving average, the 50 SMA or simple moving average. Then we're going to put on the 20 EMA. That's an exponential moving average. And the difference between an exponential and a simple is the exponential gives more weight to the more recent prices. So 20-day EMA, we have a 10-day EMA, we have a 5-day EMA, and then we also have a 50-day EMA. Now, we do have a 50 SMA up here as well, but there is a reason that I have it on there, and I'll show you that a little later. Then we have Keltner channels, also called ATR channels, average true range channels, and the setting on those are based upon a 20 bar setting. So in your charting software, we'll ask you how many bars do you want this to be figured on, and I use 20 day, and then 6 SD here means 6 standard deviations. So basically I'm going to have six standard deviations above the 20 day, the 20 bar moving average, and 6 below. So there's going to be 12 lines. So 6 above the 20, 6 below the 20. I also have on here impulse bars. If you take a look at my charts during the live stream, you'll see sometimes they're colored blue, sometimes they're colored red, sometimes they're colored green. But I will get into why that is. Fake out bars, sometimes you'll see a little triangle on my screen, a little green triangle or a little red triangle, and what you're seeing there, they're called fake out bars, developed by Larry Williams. Okay, the next one is the ATR reading of 0.45. That's the average true range reading of 0.45, and I'll get into why I use that later. Has to do with how I phase out of my positions. Then we have the MACD lines and histograms. This is pretty standard on most charting packages, and I just use the standard settings, which is the 1226 and the 9 EMA for the signal line. And that might seem complicated, but it's not. You just put in the numbers. Then I use a 14-day RSI, and then I use volume bars with a 14-day moving average of the volume. So, okay, well, let us get started. Oh, and by the way, a lot of people have asked me which charting software that I use, and I use Trade Navigator from Genesis Financial. I've been using this for 15 or 16 years, I think, and I think it's a really good program. They're based in Colorado Springs, Colorado. But yeah, they're good. And actually, in the description of all my videos, I do have a link to their website. But I've been using it a long time. I'm really comfortable with it. It has a couple features that I've never seen on any other platforms. One that I use all the time. So anyway, yeah, check them out. Another one, a free one, there's a free version, is stockcharts.com. And I believe that, I don't use it personally, but I believe that all the indicators that I'm going to show you here today are available on stockcharts.com. So personally, I would either recommend Trade Navigator or stockcharts.com. Those are the two that I am familiar with. So, okay, well, let's get started. This is a chart. This is just the SPY. I'm using just the chart here without any indicators whatsoever, but just from a very basic standpoint, in case you don't know, this is a bar of 1 day of pricing. The little tick to the left is where it opened, and the little tick to the right is where it closed. I always spend a lot of time looking at the closing price. But in case this is your first time and you're just like, what's going on here? That's what you have. Sometimes you have big bars that open here, closed here. Sometimes you have tiny bars. So anyway, we're going to just start with this premise of just the price. So, you don't need any indicators to look at this chart and realize that it's in a nice uptrend, right? But the indicators that we're going to lay over it maybe give us a little bit more information than just another chart like this. Okay, so I'm going to on the list here, I'm just going to go down through the list. So the first one we're going to be looking at is the 250-day SMA. Okay, so here's the chart just with the price. All right, now let's add on the 250-day moving average. See this line? This is the 250-day moving average. And how do you get to that? How do you get to, why is it where it's at? It's because it takes the last 250 days, adds them all up, divides it by 250, and it gives you a price. Now, I don't use the 250-day a lot, but what I do, because it's not around it very often, but I do use it for dip buys. If something closes below the 250, I may buy when it closes back above the 50 and stay above it unless it closes below. If you would have done this, you would have bought this here, it would have gone your way, it would have closed below. And if you're just using the 250-day simple moving average, you would have stayed out of this whole mess. If you would have been using this, you would have stayed out of the entire mess of the horrible fourth quarter in 2018. And you would have, you wouldn't have gotten back in down here, but you would have gotten here, you would have gotten in, you would have had one small little loss, and now you're back in and you're still going with it. So, when prices get down to the 250-day moving average, pay attention, because it may be a really good area to enter in at that level. And there's back tested results that I've shared in the past on the channel. But for the SPY, the chart we're looking at, it really does back test well. Just as simple as stay out of it below 250, get into it above 250. So anyway, first indicator is the 250-day. Okay, next indicator, and you can see I'm going to leave the previous indicator on there. So as we go through these, we're going to have more and more indicators. The 200, as with the 250, is a good indicator to tell you whether or not to be in a particular stock or ETF or not. Same with the 250. Had you gotten out under the 200 is this thick line. But if you would have gotten out of the 200 underneath, the price being underneath the 200, you would have stayed out of that whole mess as well. You know, people ask me, what's the first thing you look at when you look at a new chart? And, you know, I've thought a lot about that. And I think without a doubt, the first thing I look at is it above the 200-day moving average? Generally, I don't do a lot of purchasing of stocks under the 200-day. There are some situations where I will, but generally, if it's above the 200, I feel much better about it. You know, a lot of people use the 200-day moving average simply as if it's above the 250, we're in an uptrend. If it's below the 250, we're in a downtrend. And I think it's pretty good. I think it's pretty good rule of thumb. Paul Tudor Jones, you know, a very well-known trader, commodities and futures traders. You know, he has one simple rule: don't buy any commodity, don't buy any stock if it's under the 200-day moving average. I like to buy dips down to the 200-day moving average. When you're above the 200-day, like here, and it bounces off the 200, I like to use that as a deep dip buy kind of line in the sand, because there are buyers that hang out at the 200-day moving average. They're waiting for it to come back down to the 200-day moving average. So if something comes back down to the 200-day moving average, I feel like there's a group and support of buyers there. Now, if it loses the 200-day moving average, it's kind of important because all those buyers that come in at the 200-day moving average were still not strong enough to keep it above the 200. I guess another way to look at it is, you know, if the market is below the 200-day moving average, there's probably something really wrong with it, systemically wrong, if it's underneath its 200-day moving average. I mean, there's exceptions, of course, but the 200-day moving average is probably what I look at, the first thing I look at when I look at a chart, just to kind of qualify, is it above or is it below the 200-day? And it shapes my thinking about how I'm going to approach the stock. Okay, 100-day moving average, the next one. So the 100-day moving average is the red line, and the 250-day is about the lowest I'll go. The 200 is a major moving average that I look at, but if you lose support at the 100-day, probably your next stop is at the 200-day. And if you lose support at the 200-day, you're probably going down to the 250. So I use the 100-day moving average kind of in a really specific situation, and that is when, if a stock has been moving up nicely like it is here, and if it comes back down to the 100-day moving average at the same time the RSI, I don't have the RSI up here right now, but at the same time the RSI is in the 30 to 35 range, to me that's an excellent dip buying opportunity. So that's generally how I view the 100-day moving average. I'm kind of looking for that 30, 35 RSI to dovetail with the 100-day moving average. So, and then I also use the 100-day moving average. If I buy below it and it goes up to it, I kind of look at that as a resistance level. So out of these three lines so far, for sure, to me, the 200-day, the black line, is the most important. Okay, next moving average is the 50-day moving average. I would say that the institutional financial companies and traders, the largest ones, they look at two moving average. They look at the 50-day moving average and they look at the 200. They look at the 200 because what we talked about before, if the price is above the 200 day, like the last line in the sand, the last line that says I'm above the 200 or I'm in a bull market or a bear market is determined by a lot of people by is it above or below the 200-day moving average. Now, the 50-day moving average, that's not the be-all, end-all moving average, but when you have a nice uptrend, the same institutions that I was telling you about trying to buy at the 200, they will be interested first of all to see how it reacts around the 50-day moving average. So in this case on SPY, my opinion is they would be looking for the first dip buy down to the 50-day. That's where buyers would come in. If it loses the 50-day, then the next line of support below it may be the 100, although in this chart it's below the 200. But a lot of times you have the 50, the 100, then the 200, and then the 250. So this is the 50-day is kind of an intermediate term dip buy situation, and the 200-day is a kind of line of last resort dip buy area. So if I were buying, if all I could use was this chart here on the S&P, I would be looking for a dip to the 50 as a good dip buy opportunity, hoping that it would bounce up. But if it lost the 50, I would turn my sights to the 200-day. Okay, so those are the SMAs, the simple moving averages, the 250, the 200, the 100, and the 50. These are all simple moving averages. They give the same weight to every day. If there's 250 days, they give the same weight to 250 days or the same weight to 200 days. So now we're getting into the EMAs, which is the exponential moving average, which is they give more weight to the more recent price action. So the 20-day EMA is, I don't think the institutions turn their attention to the 20-day as much as they do to the 50 or the 200, but it is kind of an intermediate term dip buy situation. And I base all of my Keltner channels off of the 20-day as well. But in this example, you can see the price was above the 20, which is the blue. The price was above, came down, closed below, closed back up. This was the last time that the S&P has been under the 20-day for quite some time. So if this were to come down, it would probably find some support at the 20. So I might be interested in getting involved if it closed below the 20 and above the 20. But if it closes below, then the next stop is probably the 50. And if it can't hold that 50, then the next stop is probably the 200. So do you see what I'm talking about? These lines give me different support levels as we go down. We might get to the 20, who knows? We might, but a 50 would be a great dip buy. But I also use the 20-day as not just a dip buy if where the price is above and it's coming down, but also if I've bought below and then it gets up to the 20-day moving average, then I could consider that some type of resistance above me. But this is a good chart example because see how the moving averages are moving? They're in an upward slope. When they're in an upward slope, I like to buy dips back down to them. If I'm buying below them and they're in a downward slope, I like to sell when I get to those downward sloping moving averages. Okay, so the next one is the 10-day moving average. Half the weight or half the number of days than the 20-day. I use the 10-day a lot of the time for my stops. I don't really buy dips to the 10-day. I don't feel like it's maybe low enough. About the 20 is the first place that I really consider a dip. But if I am long in a trade, like say we're long here, if the price closed below the 10-day EMA, I would consider getting out of that. So I use the 10-day more as a trailing stop than a dip buy location. I hope that makes sense. But you can see from here, the S&P has used that 10-day EMA. It has acted as support here and here, got close and close. So I like to have it on my charts. I do use the 10-day also in conjunction with some moving average crossovers like the 10-day, 50-day EMA crossover. So I also use it for crossover systems to get long, but mainly I use it as resistance above me if I'm long, or if I'm long and it's below me, and if it closes below, like to lock in a profit and use it as a trailing stop. So, okay, the next one is the 5-day EMA. Now, I use the 5-day most often, very similar to the 10-day EMA, as a stop. If I want to be a little bit more aggressive with my stop and make it a little tighter, I will use the 5-day. For instance, let's say we got in here. Well, if I use the 10-day moving average, it's going to give me more breathing room. The 5-day, it's going to lock me in quicker, but it also cuts the other way, because see how it closed below the 5-day here, but it didn't close below the 10-day? So if you were using the 10-day, you would still be in this trade. If you were using the close below the 5-day, you would be out of the trade. And, sometimes one works better than the other. You don't really know. I think it's good that you just, when you enter the trade, you decide, okay, I'm going to be using this as my stop. But the further it gets above my entry price, most of the time I rely on the 5-day moving average as my trailing stop. Okay, so next one, 50-day EMA. So the reason I have the 50-day EMA on here is not so much as support and resistance, but the 50-day is this dotted line. The 50 EMA is this dotted line. Now, the 50, which the red, which is the 10-day EMA, and the dotted line 50, this is a good crossover system. One of the best ones over all markets is the 1050 EMA. So I keep this on here just so I'm aware of it, so I can see if we have a 1050 cross, I may want to get into the trade. If I didn't have it here, I wouldn't see it. I like to be able to look at a chart and just go, okay, I want to see everything. But you can see that was one heck of a trade, right? When the 10-day, the red, crossed over the 50-day EMA, which is the dotted line. So that's mainly the reason that I have it on here, is so that I can look for 10 50-day EMA crosses. So just to recap on the EMAs, we have the 20-day EMA, which is the blue. We have the 10-day EMA, which is the kind of red fuchsia. The 5 EMA, which is like the turquoise. And the 50 EMA, which is the gray dotted line, not to be confused with the gray solid line, which is the 50 SMA. Okay, I hope that makes sense. Okay, I get a lot of questions about these. These are ATR channels. And you see this green one? That is the first ATR channel. And the first, and the green one to the downside is the -1 ATR channel. So here's the 1 ATR, here's the 2, here's the 3, here's the 4, here's the 5, and here's the 6th ATR channel. And what is an ATR channel? So an ATR channel measures the movement, the average movement of a price, of the price bar over a certain amount of days. Okay, so I base mine off of 20 days. I want it to measure how far things went up and down over the last 20 days. And what does that information help me with? It can help me with how to position size. It can help me with some of my entries, because if a bar is larger than 1 ATR, there are certain trades that I won't take. It's just basically saying the volatility is too high for me to take certain type of trades. And if the bars are really big, the spacing is going to get larger between the ATR bars. You see how they're wider here and they're more narrow here because the prices here were not as large, how far it travels up or down during the day compared to here. See how these bars get quite large, and so it makes the ATR channel values get larger. So I use them to, most of the time I use them to say, look, is a certain bar larger or smaller than 1 ATR? And let's just take a look here. So this is the distance between each ATR channel. Is this bar larger or smaller than the current ATR? Well, I would say it was larger. So, if you have an average, if you have an ETA with a 20-day, you're using 20 days to figure your ATR range. If it's within the distance of the ATR channels, then that's to be expected. That's noise. But if you have a bar that is larger on average than the last ATR readings for the last 20 days, then you know that possibly something's going on, a big move up one way or the other, a large enough move that it's outside of the expected value. Another way to look at this is, what is the expected range of the bar? And the expected range of the bar in this example is from here to here, or here to here. They're all going to be the same. So the reason I have the 1 ATR and the -1 ATR bands in green is because it takes a lot of buying pressure or a lot of selling pressure to get prices outside of the first ATR channel or below the ATR channel. I really, if I had my druthers, I would like to take all of my buys within the -1 ATR channel, because it's one standard deviation away from the 20-day moving average. And the more standard deviations you get away from the mean, the more likely you're going to have mean reversion back to the mean. So I hope that makes sense. But the further you get away from the 1 ATR, the middle of the 1 ATR channel, the more you're pushing it statistically for the price to come back to the mean, for it to mean revert. So now you see this little thick line here, that is the third ATR channel. So kind of in order of importance to me is the 1 ATR channel. I like to take my entries within here because you're not far away from the mean. If you get up to a third ATR channel, there's a lot of buying that's gone on to bring you up to the third ATR channel or to the sixth ATR channel. I believe 88 to 92%, somewhere in that range, of all prices are contained within the third ATR channel to the downside and the third ATR channel to the upside. So, when things get up into this third ATR channel, I like to think about taking profits. If they get down to the third ATR channel on the downside and it lines up with something else, like possibly the 200-day moving average, to me, that is a reason to look to buy. So that's why the first one is the green ATR, because I like to see prices within here to make my buys. If I'm lucky enough that it moves my way, I start to look to sell if it gets close to the third ATR channel. Not just because it got there, it has to have some other kind of confirming kind of price action, but it gives me a red flag when it gets up into this range. And then the 6 ATR channel here, sometimes prices do get to the 6 ATR channel. It's very infrequent, but it does happen. And when prices do get to those levels, I think about, I consider that an extreme, and I may look for a trade back in the other direction. So those are ATRs. I use them to measure how large, the current bar. Is it larger than 1 ATR? Is it too volatile for me to enter a trade? I look at them as profit target areas like the 3rd ATR. I use them also. Are they within the 1 to -1 ATR channel in order for me to, get into a trade? So that's how I use ATR channels. Okay, you see on this chart, see how the bars are pink? That's normally not how my charts look. Now on this chart, you see how they're green, they're blue, they're red. So this is called the impulse system. This was developed by Dr. Alexander Elder, who is one of my teachers and mentors. And he uses this as a, what does he call it? I'll come back to that. I can't think of the word. But essentially, what this does, it measures whether or not the uptrend, the slope of the 13-day moving average is in an uptrend. Now you can't see the 13-day moving average on this chart because I don't have it on here, but that's what it's basing it off of. And then it's also basing off of what's going on with MACD. And I don't have MACD on here, so it's going to be hard for me to explain. Let me just cheat and go over here real quick. Okay, this is MACD. Do you see how the MACD, this particular MACD bar is lower than this particular MACD bar? And do you see how this MACD bar is higher? It's down, but it's higher than this particular MACD bar. And you see how this green bar is higher than the previous, but you see how this green bar is lower than the previous. So on the ATR channels, just give me 1 second. My trading partner, Katie, is wishing to come in. Okay, sorry about that. So if you look at these bars, this bar is green. What does that mean? That means that the 13-day EMA has to be an upward slope, and it has to mean also that the current MACD bar is higher than the previous MACD bar. I hope that makes sense. So this bar here is blue. Why is it blue? Well, it means that either one, the slope of the 13-day moving average bar is not positive anymore, or the MACD histogram bar was lower than the previous bar. So when they're all green, that means that both the MACD is getting stronger, and it also means the slope is getting is positive. If you look at a red bar, what does that mean? That means that the slope is down, and it also means that the MACD bar histogram has come down further than the previous bar. So Dr. Elder generally will not take a trade unless the bar is either blue or green, because he knows that the slope is upwards or that the MACD bar is higher than the previous. I know that's a little hard to explain, but the easy way to use these bars is, the way he does is, it's a filter. the impulse system bars are a filter. If it's red, you just don't buy. If it's green, you can buy, and probably the best bars to buy on are the blues because they are kind of neutral. Now, I don't use it exactly the same way he does, but I certainly always look and say, hey, is it green or is it blue? And to go further, he actually needs the bars to be either blue or green on 2 time frames. So the weekly has a blue, the daily has a green. So that would be okay if he had some kind of setup. So, this, I think it's a plugin. Like I said, it is available on Trade Navigator, and I believe it is available on stockcharts.com. It's not a huge part of what I use to trade, but I like to have it on there because if at all possible, I like the bars to be either blue or green when I buy. Although when I buy a deep dip, it's not going to be, I know it's going to be red. But anyway, I have them on there. People have asked, and that is why. Okay, fake out bars. So fake out bars are, this is an indicator used or developed by Larry Williams. And it's not a big part of my trading. It's an indicator that if it confirms, in addition to all the other indicators that I'm looking at, then it'll kind of push me over the edge to take the trade. Like for instance, if I had 2 identical charts and one had this signal, this fake out signal, and the other one didn't, I would take the one with the fake out signal. But basically, the reason I like this is because in a bigger picture, it mirrors how I like to look at the trades. You hear me talk about V1s, V2s, you hear me talk about the price going down, reversing back up. So, it trying to go down, finding no more sellers and reversing back up, giving you more confidence that there are no more sellers down there. So, the reason it's called fake out is that it goes one way and then fakes out and goes the other. But the reason, see how this is a green triangle right here? The reason it painted a green triangle was because here we have a day up. This bar goes higher than this bar, but then you see how it closes below the high? So it looks like it's going the other way. Now, whenever you have prices that have one bar up, and reverse, it will paint that triangle. That doesn't mean to buy it. When you buy it is if the next day it goes above this high. So here we have up, this went up above this high and then closed below this high. The signal is if it then takes out the high, not of this bar, but of the bar before the triangle. So like I said, I wouldn't just take these, every single one that came along. They would have to line up with, other indicators or other patterns that I was looking for. But I got to tell you, over the years, it has definitely had a positive impact on me, on my P&L, using this just as kind of a tertiary type of signal. Let's take a look, see if we have another one. This bar here, we went higher than this bar, then we closed lower than this bar. This would have been the entry, and that was a good trade. And they also worked to the downside. So as far as getting this, I am not sure. I know you can get it through Trade Navigator. I believe you can, at least 15, 16 years ago is when I got them. I don't know if they offer them still, but people always ask me, what are those triangles on there? Those are red and green triangles, and so that is what they are. Okay, off to the 0.45 ATR. So I use these specifically for scaling out of my positions when I have a profit. So this is 0.5 of an ATR. Remember when we were talking about ATR channels? Well, 0.5 ATR equals 82 cents. So from here to here is more than 82 cents because 82 cents is just 0.45 of an ATR. So when I get out of a trade, when I phase out of a trade, let me put it this way. One ATR shows the average true range, the expected range. So if you go from here to the next ATR, just statistically, there's probably a pretty good chance you're going to stall out there because that is one ATR. That's the expected value. And to go beyond that, you kind of need more than just noise. So when I scale out, I use a 0.45 ATR. And the reason I use 0.45 is if you go from this ATR to this ATR, that's one ATR. If you go halfway of the ATR, there is going to be some mathematical resistance at that halfway before it gets to the other halfway. So I could use a 0.5 ATR, but I know I'm going to run into a little bit of resistance mathematically at that halfway point. So what I do is I use a 0.45 ATR because it gives me, in my opinion, it gives me a little less resistance with almost getting the whole 0.5 ATR. So that's if I hit one profit target. I'm going to hit it about right here before we get to kind of some expected resistance in the middle. If I hit two ATRs, that's 0.9 ATR, that lets me take profit here before we get to that full ATR. So I hope that makes sense. But most charting softwares allow you to get this value. You can find out what one ATR is, and then you can just, the worst case scenario, just use that value and times it by 0.45. But luckily Trade Navigator, there's a way that just comes up with it for me every day. But people ask, what is up there? What is that number? That is one of the values that I put into my formula when I look to phase out of a trade. And it works really well. So I don't know if Stock Charts has that. I'm not really sure. I know Trade Navigator does. But I would imagine most charting softwares, even in the worst case scenario, you could find out what the value of one ATR is. And if you find that out, then you can find out what 0.45 is. So, that's if you want to phase out. That's what I do. I do recommend it to people if they want to take the time and energy to do it, but it is some work. But it allows me to get out in spots that everyone's not looking at. I think that's the best way to put it. If people were trading ATR channels here, they would probably, everyone's going to focus on this level. And so everyone's probably going to put their stops in and around this level. I like to put them in spots on the way up that no one even knows about or cares about. But I need this value. I need this 0.45 of the average true range to give me that. Okay, MACD. So MACD is a momentum indicator. And, the signals, the values that I use are 1226, and then I also use a 9 EMA on the signal line. And I know that sounds complicated, but it's not. You can see right here, here are the values. Here's the value for here. And almost all charting softwares have MACD, and probably the 1226 and the 9 are the standard preset values. What is MACD? Well, it's a momentum indicator. It's a momentum of trend, and I use it all the time. I use it for an entry signal, like such as here. See how the green crossed over the red? So it's kind of like a moving average crossover system, but this red line here is the signal line. And whenever we cross above the signal line, it's showing that the most recent price is moving up. And when it closes below, it shows the recent prices are moving down. And I like to use them when you have a double top or a double bottom, or like for instance, see the S&P here, see how we're continuing to move up, but at the same time, look at the MACD histogram bar. See how it's getting lower and lower? That's showing there's a slowing of the trend. So anyway, I talk about this stuff all the time on the live stream, but basically I use this indicator all the time for one, entry signals, two, to alert me of double tops or double bottoms. As far as if I'm long a double top, I may want to get out. If I have a double bottom with the MACD divergence, I may look at getting in. So, but those are the values. It's available on all charting platforms. So that is what MACD is. Okay, RSI. You hear me talk a lot about RSI, and RSI is a relative strength indicator. And basically, it's a momentum oscillator that measures the speed and the change of price movements between 0 and 100. So basically, how fast, how far, and in what time period has something gone up? How fast and how far is it going up? And the way I use it is there's 3 key levels for me. And oh, by the way, the settings are a 14 RSI. So based upon the last 14 days. So, but the way I use this is I use 3 key levels: the 30 RSI, the 50 RSI, and the 70 RSI. If a stock is moving upwards and it gets up to a 70 RSI, that means it's moved pretty far, pretty fast, and the RSI reading is going to be pretty high. Generally, people consider 70 as a overbought scenario, and they consider a 30 as an oversold scenario. So if I buy, here, close above the 20-day moving average, and it starts getting up into the 70 RSI range, it doesn't mean it's going to go down. It just means that based upon a lot of people's opinion, that it's run a little too far, too fast, and it will probably slow down there, move sideways, or possibly move back down. So if I buy something at a 50 RSI, I target the 70 RSI. Now, it doesn't mean that it won't go up, but for me as a swing trader, that's the range that I'm happy to take it in. Now, if it's above 70 and it comes back down to the 50-day, well, that 50-day is going to act as some support, just like the 20-day moving average might act as support. If you're above 50 and it comes back down to 50, you're probably going to have some support there. If you lose the 50, then it's probably going to go closer down to the 30. Now, if you buy at the 30, because at the 30 RSI gives me an area about where I get interested in buying, because now it's oversold, and I know there's going to be some buyers down there at those low RSIs. Just like when it's above 70, when it gets up to 70, I know sellers are going to come in. When it gets down to the 30, most likely there are going to be some buyers going to come in. Doesn't mean it's always going to hold, but that's the premise that I work upon, where the buyer's going to be. But look, if I bought at the 30 RSI, do I think it's going to go to the 70? No, I don't. What I most likely think is it's going to go from the 30 to the 50. Remember how when we're above 70 and it comes down to 50, you're going to have some support? Well, if you're underneath and you're going from 30 to 50, you're probably going to find some resistance at the 50. Now, if you get over the 50, then you might go back up to the 70 where you're going to find support again, and then it might come back down to the 50. And if it loses the 50, it might go to the 30. So anyway, RSI is something I look at and use a lot. It's on all charting platforms. I use a 14 period. Okay, and then volume. Of course, every charting platform has volume. It's something I look at every day. What I do put on there is I put a 14-day moving average of volume here, so I know when if it goes above that, I know that it was kind of an extraordinary day of volume. Something has a big day up, but it seems big, but it's still underneath the 14-day moving average. I know it seems big, but just on average, it was just an average day. Like this day was a way above average day on the SPY. So volume's pretty simple. I do use it. I use it as a confirmation type of signal. If I have a big breakout, I like to see it on strong volume. I look at volume as kind of votes of confidence. If something is going up on high volume, it gives me more confidence that a lot of people are participating in it. If you're at a bottom, if you're at the bottom of a deep trough in the market and you have a big day up with big volume, again, that's a lot of votes. It's a lot of confidence. If you are going to the upside and you have a big down day on big volume, that means to me that there was a lot of non-confidence and there was a lot of confidence in selling. So it is something that I use. And, with all these indicators, one thing I do want to say is that I don't really rely on one indicator. I need as many indicators to show themselves to me in a positive way before I take a trade. At least I'd like them to, like the price being at the 200-day, the RSI being at 30, there being a double bottom with the divergence, the price coming down to the 20-day moving average at the same time that it's a 50 RSI. So those kind of things. I don't think that any one particular indicator you can beat this market and take money out of this market. I think you need to have as many indicators as possible align. So anyway, those are my indicators. Let me show you one more time our list. So 250-day SMA, 200 SMA, 100 SMA, 50 SMA, 20 EMA, 10 EMA, 5 EMA, 50 EMA. The Keltner channels, you want 12 of them, 6 above, 6 below, using 20 days as your value. The impulse bars by Dr. Alexander Elder. I'm pretty sure Stock Charts has those, and Trade Navigator. Fake out bars, buy and sell, Larry Williams. The ATR reading of 0.45. This is probably one of those that you need to call your charting software program and say, hey, how can I get a value of 0.45 of ATR? MACD lines, the 12, 26, 9, the RSIs, the 14, and the volume with the 14-day moving average. So let's turn this back on. Hey, there I am. Hi. Okay, so anyway, I hope that helps. I think this is a good reference point for people to come back, because like I said, I have had a lot of people ask me, what are all those lines? What are all the values and so forth? So anyway, I hope you found this helpful. And if you did, I appreciate it if you would give me a thumbs up. And I hope everyone will show up Monday at 1 p.m. Mountain Standard Time, which is the last hour of the trading day, depending where you're at. So these are the indicators that we use on the live stream. And so we're going to be talking about these every day during the last hour of the market. So, and lastly, I should mention that I do offer private one-on-one teaching and coaching sessions via Skype during the evening time. So if that's of interest to you, my hourly rates and my contact information are in the description of this video. So anyway, hope to see you Monday. Have a good rest of your weekend, and we'll see you soon. Thanks. Bye.
U.S. Government Required Disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice. and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.